Well, it's a good time for a conversation about Geithner's remarks. Joining us now, Dartmouth economist Danny Blanchflower, a Bloomberg contributing editor and an advisor to the Boston Fed. Danny, good to see you. You're in Hanover, New Hampshire this morning.
Hi, Erik.
Let's talk about Tim Geithner's remarks. You heard him talk about the president's tax initiative, and he also spoke about Europe, something that we discussed at length last week. Tell me, in your opinion, how convincing, how reassuring are the Secretary's remarks about Europe, given his experience there last week and, of course, the big focus right now on taxes?
Well, I'm not sure how convincing he is, because he did sort of, if you like, get rejected by the Europeans, but he really does have a point. The US was faced with a major financial crisis, which eventually we got through it. I mean, Lehman's fell, but eventually we got through. The UK's banking system, same thing, rescues came. But it looks like the Europeans are struggling to actually come through with this. They're struggling to deal with their banks, and they're struggling to get any growth going. So he certainly has a point. But the question is, are these Europeans going to actually respond to what he says?
Well, Danny, I mean, how fair is it, though, that Geithner is saying Europe should take a page from Europe, from rather the U.S.'s playbook? I mean, we have one language, one currency, one unified Fed, and Europe, as we know, a lot more voices.
Well, obviously, it's a relatively difficult thing to do. But I guess what I would think about is the timing. I mean, I've been on talking with you, I think, probably for about 18 months about this crisis, and they haven't managed to put a backstop to it. The crisis has continued. So in some sense, you're hearing his frustration about the fact that this thing continues on and does represent, if you like, a downside risk to the US economy. So it's something that obviously the Treasury Secretary has to take a view on, and he's obviously frustrated that this crisis in Europe doesn't seem any closer to getting fixed.
Is he correct, Danny, that the Europeans will simply have no choice? This is more or less what he told Juliana yesterday, that they will have no choice but to follow the roadmap set by U.S. policymakers, because that's the only way you can deal with a crisis like this. They've evaluated the things that work and the things that don't work. This is what he said, and we all know what works.
Right. Well, I actually agree with that. I think what's happened is it's inevitable you have to deal with the problem. You keep pushing away the evil hour, but eventually what you realize is, as Geithner was saying, you rescue the banks and you sort this thing out eventually, and you have to pay for it. It looks horrible. But what they'll soon eventually realize is every other option is worse. And what we've seen today is Italy downgraded, and the question then is, well, if you don't sort it out now, which country's next? Or is Moody's going to downgrade Italy? So I think the answer is that you have to deal with it, you have to bite the bullet and realize this is going to cost you a lot of money. And all this stuff today about Greece eventually has to get some growth and a tax-raising structure, tax authorities, and reforms in the product and labour markets. And none of this is a long-term fix yet.
Still with us, Bloomberg contributor and Dartmouth professor Danny Blanchflower, an advisor to the Boston Fed and former member of the Bank of England's Monetary Policy Committee. And here in New York City, Columbia professor and former Fed consultant Charles Calomiris, and our own economics editor, Michael McKee. Danny, I'm going to throw this to you, but it's actually a question to all of our panelists. Is this a good idea, Operation Twist, a bad idea, or will it be effective at all?
Well, I think it's a good idea. The Fed clearly feels like the economy is slowing, the data have worsened. I think it may well be a first step. A first step, you start to do Operation Twist, you go to buying longer-term bonds. But my suspicion is, and it might even happen tomorrow, they will extend QE. So it might even be part of a process where they buy more assets. And I think it probably is the right thing to do. But I think some people are going to say it won't have much of an effect. A study came out from the Bank of England today talking about what these QEs have done and argued that they have really quite large effects. So that was out yesterday. So I think it's the right thing to do, and I think they're going to do more, especially if the data slows.
I'm sorry, I can't agree with that. I think we should call it Operation Twist in the Wind, since it's an act of desperation by a Fed that's trying to pretend to do something. It's likely to have significant harm in the medium term. It's not going to do any harm. It might even do a small amount of good in the short term. But it's going to make the Fed's balance sheet much more unwieldy, much harder for the Fed to climb down. when it will need to several years from now from this bloated balance sheet full of long-term securities. The authors of this themselves, as academics, wrote about the first attempt in 1961 with Operation Twist, which everyone sort of agrees may have had as large an effect as 10 basis points on long-term bond rates. That's a very small effect, and it's a very short-term one with big medium-term costs. It's short-sighted.
Well, here's the problem for the Fed. And, Danny, I know the Bank of England study suggests it can have big effects. You can bring down interest rates, and you can have a couple of basis points or 10 or 20 or 30 basis point move. But that hasn't translated into helping the economy. And that's what the American people are looking at. Interest rates came down, but we can't borrow or we don't want to borrow. And until they can solve that problem, essentially you're pushing on a string here. And the Fed is more or less out of bullets unless some move increases confidence some way. And
I would also say that the interest rate decline that we've seen doesn't really line up with QE2. That is, the initial effect of QE2 in terms of its announcement and its initial effect on the bond market was actually to raise interest rates. The reason long-term interest rates have come down is because the economy is in the tank. And that is the main thing that's been driving long-term rates and will continue to do so.
Danny?
Well, obviously, the issue we're discussing here is what the counterfactual is. What would have happened if these actions hadn't have taken place? My view, and I think Bernanke's view, is that the economy would have been in a much worse place. I mean, the Calomiris' comments now really depend upon what the size of the counterfactual is, and I completely disagree with him. I think we're still in a position where it looks like we should have negative interest rates. It's the only show in town when cuts are coming fiscally. We have these really very strong headwinds. Being someone who actually voted for this stuff, I remember where we were sitting thinking about what was coming. It actually prevented the economy from going over a cliff. And I think it's the right thing to do. And the truth is that the Bank of England has actually been buying these longer-term rates, and it does look that these longer-term treasuries, it does look as if they have worked. So I think this is where they're going to go. But the question through it all is, what's the counterfactual? And Calomiris can say that, but he has absolutely no clue what the counterfactual was. And if you say that it's a much bigger effect and the economy would have been in a much worse place, then you argue it's had a much larger effect than he's claimed.
You know, I think the main thing to disagree with in that statement, so we don't just keep rehashing things, is to say that the Fed doesn't have any additional tools. Of course it has a big additional tool, which the Fed's real agenda seems to be moving toward, which is raising inflation. I think that the real goal here that's lying under this sort of, I think, nonsensical discussion about QE2 and Operation Twist is really that the Fed's hidden agenda, because they're embarrassed to say it
is to inflate our way out of the debt problem?
Right. And I think that it's a very bad idea. It will have huge medium-term costs. We've already lived through this sort of myopia before, where the Fed stumbles into higher inflation because of its politicized nature, which is where we are right now, just like the 60s.
Danny wants to
with huge negative costs.
Yeah, well, no, I don't agree with that at all. I mean, what we've clearly realized is that having inflation so low, having, if you like, an inflation target that's so low, has brought into play the whole point of controlling inflation, if you like, is to keep the economy stable. Having this low inflation target has put us close to the nominal bound. So we're going to have to get inflation up for a while, mostly because we're going to have to get interest rates up. So I think this idea at the moment, create some inflation in the medium term, is probably the sensible thing to do. Olivier Blanchard at the IMF has been arguing for it. I think we're going to see around the world a bit of inflation if we can create it. But that's not going to go to hyperinflation at all.
I think what you come down to is Danny's right in the sense that we don't know what the counterfactual is, and we don't know whether any of these policies that the Fed still has in its toolbox will work, and they're experimenting right now, and that's the tough part.
Absolutely.
All of this is theoretical. We have no practical experience with any of these things at this moment. So if Ben Bernanke wants to try, we'll find out we are the experiment.
We have. Yeah. What it's like we're all guinea pigs. I guess that's the last word. Mike, thanks very much. Charles, you're staying with us. Danny, always good to see you. Our contributing editor, advisor to the Fed, Danny Blanchflower.